So in today's lecture, we're going to take a look at Chapter 5, Inventories and Cost of Sales. And when we're looking at inventory costs, it's important to know that it's going to include all goods that the company owns and holds for sale, and that some of these items are going to require special attention, such as goods in transit, goods on a consignment, and goods that are damaged or obsolete. But it's also important to note that the price in which the company pays for these goods might change over time. If you think about the same price for the goods that are procured, what inventory costing systems used is somewhat immaterial because the cost of goods sold is going to be the same for every item, and the ending inventory cost is going to be the same for every item. But if there are some items purchased at a lower price and some items purchased at a higher price, which item is treated as being sold is going to become extremely important for determining cost of goods sold as well as that inventory amount. Now under GAAP, we've got 4 different types of inventory costing systems that we're going to look at. Specific identification, first in, first out, or FIFO, last in, first out, or LIFO, and weighted average. And as you can see by the chart on the right, the majority of companies are going to use this first in, first out, and it's going to have some properties that most companies will find desirable, and we'll talk about that a little later in the slide presentation. But we'll walk through each of these and explain a little bit of how that calculation is done. Looking at some differences between these costing systems first, if you look at first in, first out, and last in, first out, we're talking about ordering for the way in which we're going to determine costs. So if we had purchased 3 inventory items, one at $45, the next one at $65, and then the third one at $70, we're going to care in terms of whether it was the first item or the third item that was sold, for example. If we use first in, first out, we would use the first item purchased as being the first item that gets treated as sold. So here, if we had a net sale, for example, of $100, the cost of goods sold would be $55, and we'd have gross profit of $55. Ending inventory would be the balance, that 65 plus 70, or 135. Now, if instead we used a last in, first out system, that $70 item is what would get treated as sold. So the cost of goods sold would be 70, gross profit 30, and ending inventory here would be 110, so that 45 plus the 65. So you can see that in traditional rising price environment from the supplier, that LIFO has the effect of making cost of goods sold higher and thus gross profit lower, as well as inventory lower, whereas FIFO makes the gross profit higher and inventory higher. Weighted average is going to give you a little bit of a split between the two, to where you're going to add up the entire cost of the warehouse prior to the sale, divide by the number of items. Here, we would have $180 for the amount of the warehouse cost, 3 items, so $60 a piece would be the average. Now, even though no single item in this warehouse costs $60, we're going to treat each one as if it were $60. So when the item is sold, we'll have net sales of $100. Cost of goods sold is $60, giving us a gross profit of $40. And then the ending balance would be $120, the 60 plus 60. And you can see that that gives us a gross profit in between what FIFO and LIFO gives us, and gives us a inventory balance in between what FIFO and LIFO gives us. And the reason that this is so is because of this cost flow, to where the merchandise that's available for sale has to come from one of 2 places. Either we have it or we go out and get it. Here, have it is looking at our beginning inventory, and getting it is our net purchases, to where we go out and purchase new items to add to the warehouse. And of that merchandise available for sale, it's got to go to one of 2 places. Either we use it or we store it. Here, using it is selling it, going to cost of goods sold. Storing it is going to our ending inventory. Now, the ending inventory costing system is going to have 2 different effects. We're going to have a balance sheet effect for that ending inventory, and we're going to have an income statement effect from that cost of goods sold. It's also important to know which accounting system we use doesn't need to follow the physical flow. So in other words, if we actually sell the oldest item that we purchased, we are within our rights to use specific identification, first in, first out, last in, first out, or the weighted average as our accounting system, as long as we've, these inventory costing systems tend to be a little bit sticky. So once a company has selected the system it's going to use, it tends to need to stay with it. But the physical flow of inventory, the physical flow of the items sold does not need to line up with it. So in other words, if you sell the oldest first, you can still use LIFO. If you sell the newest item that goes into the warehouse first, you can still use FIFO. So let's take a look at an example illustration here. So here we've got beginning inventory. So the first ones we had purchased of 10 units for $91 per unit. So we've got $910. We make another purchase of 15 units at a little higher price, $106. And then we make an initial first sale of 20 units. The next two purchases are going to be of 20 units and 10 units. And again, we're in what we traditionally might see the supply chain in terms of our supply costs increasing. So we've gone from 91 to 106 to 115 to 119, which has the effect that we saw earlier from FIFO giving us the higher inventory and higher gross profit, and LIFO giving us a lower inventory and lower gross profit. What we have for the total amount here is going to be 55 units and then 5,990 for goods available for sale. We're going to sell 43 units. We're going to have 12 units left in the inventory, but we want to know for the costing system how much of the cost of goods sold is going to get assigned there, and then how much is going to get assigned to ending inventory. So specific identification is one we did not look at in the earlier slide. And the reason why is it's going to be based on the actual items sold. So whereas LIFO and FIFO do not need to follow the physical flow of the items sold, and weighted average is just going to be the average. So almost by definition, it's not going to follow the physical flow. Specific identification will do that. So specific identification is no kidding which item was sold and what was the cost of that item. For most companies, this isn't going to be that reasonable of a costing system because it doesn't matter whether if you're selling rolls of paper towels, for example, whether it was actually the first paper towel that you put in the back of the warehouse or the last paper towel that you put in the front of the warehouse that physically got taken out of the warehouse when the sale was made. But if you can imagine perhaps larger, more complex items such as cruise ships or airliners, or if you're selling exotic sports cars, you may care a lot about whether the sports car sold was the V12 with the leather seats or whether it was a V8 with pleather seats or cloth seats, because the cost is going to make a big determination in terms of what you actually have in the inventory, as well as what was your actual profit of that sale. Now for ordering, the first in, first out is going to look at the oldest cost. So the oldest purchases are going to get assigned to the cost of goods sold, and the most recent ones are going to get included in the ending inventory. So looking at that example again, we're going to take for our cost of goods sold in the August 30th actually for the August 14th purchase, we're going to look back. Of those 24 items, we're going to use 20 of them in the sale. We're still going to have 5 items at $106 in our ending inventory. So when we make that August 30th sale, we're going to treat the first of the 23 items sold, the first 5, as being those $106 items. And then we're going to go to the next oldest, the $115 items, to take 18 of the 20 that we have. And that's going to be including cost of goods sold. And then we're going to have for the inventory balance, the most recent purchases. So all of the 10 that were purchased at 119, and then only 2 of the ones remaining are from the 115. Last in, first out is going to do just the opposite for ordering. It's going to look at the most recent cost for cost of goods sold and the oldest cost for ending inventory. So for the August 14th purchase, we're going to look at the 20 items sold. Here, we're going to use all 15 of the $106 items. That's going to get included in cost of goods sold, and only 5 of those 10 from the $91. And then when we go to the August 30th sale, we're going to use all 10 of the 119 items for cost of goods sold, and then the 20 items at 115, we're going to use the balance of that 23, so 13 of those for the 115 for that cost of goods sold, which is going to leave us an ending inventory including the 5 that we had in our beginning balance. So the very oldest August 1st date of $91, we're still going to have remaining. And then the 115 that we had from the August 17th. Now, weighted average is going to give us a balance of the two. So prior to every sale, we're going to take the average cost of every unit in the warehouse and treat every item as if it had that cost assigned to it. So the cost of goods sold per unit will be the same as the ending inventory per unit for that single sale. Now for the first in, first out, if we look at the costing method and its effects, it's going to have ending inventory that's going to approximate the current cost. So we're going to have more accounting information or more relevant information perhaps on our balance sheet. Whereas last in, first out is going to have the cost of goods sold on the income statement that's going to more approximate those current costs. So we might have more relevant accounting information in our income statement in contrast with the balance sheet. And then weighted average will smooth out the changes. Again, it's going to give you something in the middle for gross profit and give you something in the middle for ending inventory. Now we saw at the beginning of the slide presentation that first in, first out, FIFO tends to increase gross profit and tends to increase ending inventory. So if you're a CEO or CFO and you're being charged with making shareholders more money and perhaps getting more economic resources and including inventory to do that in the future, from an accounting standpoint, you've got an inventory costing rule that appears to do just that. And we do see that about half the companies follow this, possibly to some extent because of that. But for publicly traded companies, there's something called the LIFO conformity rule from the IRS, which says that whatever you're telling your shareholders for financial reporting purposes also has to be the same costing system that you're telling the IRS. So if you're telling in the financial reporting system your shareholders that you made more money, you're also going to have to tell the IRS that you made more money. You're going to have to pay more taxes on that more money. So often, publicly traded companies will use LIFO. That way they can tell the IRS that they made less money and have less inventory. But at the same time, when they tell in the financial reporting systems their shareholders, you can also informally through conference calls explain that we're using LIFO to do this calculation and explain what the difference between a LIFO and a FIFO accounting rule would be. So you can still convey that information to financial analysts, indirectly to shareholders or directly if they're on the call. But you just can't do it in the financial reporting system. Your official rule has to be the same as that for the IRS, for the conformity to hold. Now, for companies, especially using FIFO, they're going to have these elevated inventory systems. There's also this lower cost or market that's going to be included here, to where we're going to take a look at our inventory, and we want the more conservative number that's applied. So if we have a lower cost than what the inventory is perhaps physically worth currently, we're okay keeping it with that lower cost as our what we reflect as our ending inventory. But if we have an inflated number, if we have a higher cost on our balance sheet than what that replacement cost would be, what we could go out to the market and purchase that item for, then what we're going to do is we're going to take an expense and reduce that inventory to that lower market value. And what that's going to look like for the journal entry for the write-down is we're going to take it as a cost of goods sold, and we're going to credit that amount to the merchandise inventory to reduce that inventory. So here, seeing a $30,000 cost of goods sold debit, $30,000 credit to merchandise inventory, and we'll see that that's going to drop our total inventory from 220 to 190. And we're looking at this by an inventory item by inventory item. So in the case of the Roadster, we had 170,000 was the total cost, and then we had 140,000 was total market. So we'll reduce that to the 140,000. So we're going to have a $30,000 cost associated with the Roadster. For the Sprint, we have a $50,000 total cost, $60,000 market, so no adjustment here is needed. We can keep the $50,000 cost that we have assigned, and so we'll have the $30,000 total for that reduction to get assigned, or excuse me, to get debited to cost of goods sold, and the $30,000 credited for the merchandise inventory. Now, if we do have an amount that's understated on ending inventory, what that's going to do because we're splitting those available those goods available for sale between ending inventory and cost of goods sold. Understatement for ending inventory is going to be an overstatement initially for cost of goods sold, which is going to understate net income. And the converse is true, where if we overstate ending inventory, we'll be understating cost of goods sold and overstating net income. And if we end up letting this play out over time, it'll end up reversing itself. So if we understated ending inventory and then we sold the remainder of the inventory, whereas we overstate cost of goods sold initially, we'll understate it the following year, and we'll overstate net income in that following year as well. And conversely, if we overstated the ending inventory, we sold half of it, which would understate cost of goods sold, overstate net income. The following year, when we sell the remainder of that inventory, we'll overstate the cost of goods sold and understate the net income. And for the balance sheet effect, understating the ending inventory is going to also understate our total assets, which liabilities being kind of set will end up having the effect of understating the amount of equity that we're holding. And then converse is also true. The overstating the ending inventory would overstate the assets, and then us overstate equity. So let's take a look at one of these ratios here. And then for inventory turnover, what we're going to do is take the cost of goods sold divided by average inventory, and this is going to give us a measure of how fast we're able to turn over the warehouse full of goods. So if we have a higher number here, then we're going to end up selling those goods faster. So we're going to be more productive. The converse of this is going to be day sales and inventory. So instead of taking cost of goods sold divided by average inventory, if we looked at ending inventory, for example, divided by cost of goods sold, and multiply that by the year, days in the year, 365, we can get a measure of how many days that each item is sitting on the inventory shelves. So whereas for inventory turnover, we want the higher number to kind of show that we're being more productive, that we're selling items in our warehouse faster, we're selling the amount of inventory we hold in a warehouse faster. That for day sales and inventory, we're going to want, as managers, that number lowered. Where if we have inventory that's in our warehouse, we don't want it sitting on the shelves for an extended period of time. That's money that we're tying up in inventory that could otherwise be put to investment in other resources. You also note we kind of changed the way we're measuring here from average inventory and inventory turnover to ending inventory for day sales and inventory. Depending on the financial analysis that's done, you might see that listed actually as average inventory for day sales and inventory here as well. Some financial analysts will do that. That way you're just using the reciprocal. You're taking 1 over inventory turnover multiplied by 365. And then another kind of variation that you might see is instead of 365 days in a year, you might see 360 days in a year. And that's set up just for 90 days per quarter, so it gives you a good approximation both of quarterly day sales and inventory as well as annual day sales and inventory. And then when we're comparing these, again, we don't know what a good inventory turnover is in a vacuum, so we're going to do one of two things with it. Either we're going to look at it against the competitor. Here, 11.9 times is what Costco has, 8.3 8.3 is what Walmart has for the turnover. For day sales and inventory, we've got the labeling a little wrong here. So day sales and inventory should be 32.1 days, and the inventory turnover for Walmart should be 8.3 times. So the Costco number is going to be slightly more productive than the Walmart number, and then day sales and inventory is going to reflect that. 30 days on average for a Costco item, whereas a Walmart item will sit in inventory for an average of 43 days. So Costco is a little bit more productive when compared to Walmart there. And if we look at it over time, going from 1 year ago and 2 years ago, Costco seems to be doing a little better, but about the trend being about average. Same thing for Walmart, difference between 11.6 and 11.9, 8.1 and 8.3. But it gives you a sense of whether that trend is improving or that trend is declining. And that's going to conclude our lecture on Chapter 5.